class or mathematics.
In order to find volatility, we need to use standard deviation formula.
Okay, this is the formula for standard deviation. So this 1.04% came from the standard deviation formula. We need to double check this formula. Okay. Okay, and what does it mean? What does it mean by volatility? Let me just give you in advance. Where is that one? Okay, so volatility basically means that it is the advanced form of risk. You can say that volatility means that in one day or in 1 month, what is the increase and decrease in currency. You see this kind of movement in graph. So if you open some kind of Forex, right, what's going on with the yuan or dollars, you see this kind of in one day or in 1 month, this kind. If you take out the average is like this, it's increasing like that. But if you see daily or minute by minute, the currency would move like this. Right? So this is called volatility. The movement of currency up and down, up and down, up and down, up and down. In certain period, we call this volatility. And this is also a risk. For example, and how it is a risk, let me just, for example, you want to sell these 5 million yen, and we saw that this was the contract rate. We enter into a forward contract, so we fix this amount. So we don't worry about the volatility, we don't worry about the risk whatsoever. What if we don't enter into this contract and the expected spot rate was 0.0090? But that was, for example, we take when after 60 days, we saw in the market at 4 p.m., the rate was 0.0090, but at 5 p.m. the rate is 0.0091, and at 6 p.m. the rate is 0.0090 again. And when you have this 5 million, you have this range, right? If you see the average of the whole day average is 0.0090, but different periods of time, it is, for example, at 3 a.m. it is 0.0089. It means currency is moving around this 0.0090 with some kind of percentage, 1% or 2%. So that is called volatility. So this is more advanced concept. In your further studies, this will be more discussed. We can also calculate this volatility with different formulas. So this is just, giving you a taste of this next level. That standard deviation is the risk, but this doesn't tell us this risk is how much and what is the timing of that risk, right? So normally currency don't go, for example, if today was the rate of 90, that doesn't mean that in whole day the rate is like fixed. In some timing rate go up, in some timing rate go down, in some time go up, go down, go up. And when we normalize this, take an average rate is 0.00990. Understand, David?
Yes, sir, I understood.
Okay, now exchange rate equilibrium. So I also explained this concept in our YouTube lecture, our previous lecture as well. But today we will talk, explain more on these details. So that is, the exchange rate represents the price of the currency. We already know that. It means it is the rate at which one currency can be exchanged for another. So what is the demand for the currency? Those who want to buy that currency will create demand. So demand is created by buyers. So recall our discussion of economics, what is demand and what is supply. So demand means buyer want to and able to purchase that thing. We call that buyers are creating demand. So who creates demand? Buyers. So if I say that some people want to buy pound, it means those people are creating demand for pound. Okay, so demand for a currency increases when the value of the currency decreases. What does it mean? So what is the law of demand? Law of demand says if price is higher, quantity demanded is lower. So as a buyer, what is your priority? Pay less. So demand decreases and price is higher. Demand increases when price is lower. Similarly, the supply, let me just erase. What is the law of supply?
More
If price is higher, quantity supplied is also higher. So who creates supply? The suppliers or producers or those who want to sell the currency, they create supply. So supply increases when the price increases. And what does it mean by price? Price is called foreign exchange, right? The value of the currency is called foreign exchange. So forex increases, it means supply of that currency increases and demand decreases. This is law of demand, right? And this is law of supply. So let's read that. So supply increases when the value of the currency increases. Now you understand what does it mean by the value of the currency? We're talking about the rate. So leading to an upward sloping curve and demand is downward sloping. And what does it mean by equilibrium? Equilibrium is that state or that point where the demand and supply intersect with each other. So let's talk about that. So, okay, we have a last point, that is in liquid spot market, exchange rates are not highly sensitive to large currency transactions. What does it mean by liquid? Liquid means when there are
unstable.
Liquid means when there are large number of volumes of transactions occur. For example, there are many buyers and many sellers. So ability to convert into cash is higher. That means by liquid. Liquid means ability to convert into cash. The more liquid is the market means the ability to convert into cash is higher. It means the competition is high in that market, or many people are there who want to buy and sell. So that's why we call this liquid. So in liquid market, not large currency transaction, they do not affect the exchange rate. For example, there's a big order come into the market. For example, buying $1 million of $1 million. So the price starts rising if the market is not liquid, if the currency is not liquid, or currency is not acceptable or largely tradable. So what happened? As soon as you want to buy $1 million, the dollar price starts rising because you are buying. So it creates pressure on the, let's talk about that in intersection. So this is the demand. Demand is downward sloping. And this is the market. So this is the demand for pound. So that's why this is the value of pound in terms of dollar. So this is not the demand for dollar, since it's the dollar written here. Remember, this is the price. And price is $1.50, right? So things in terms of demand and supply curve, but think also in terms of exchange rate as well. Exchange rate is the price of the currency, and we are talking about pound. So this is the price of the pound in terms of dollar. So some students are confused. This is the demand for pound, but why there is a dollar written here, right? So this dollar is written because this is the value of pound in terms of dollar. Okay, supply curve is upward sloping. So this is the price of pound. So you see, when the price rises, quantity supplied also rises. This is the supply schedule. And exchange rate here. So that liquid spot market concept is that if the, for example, if the currency is not largely recognized, for example, let's take the example of supposition that dollar is not very tradable or not very recognized currency. And $1 million order came. It pushes the demand towards the right side. And what happened? You will see that the price start increasing. So in that case, the liquid spot market means even if 10 million order came, the value is still here because the market is liquid. It means there are many buyers and many sellers, and there are a large number of transactions going on. So the large transaction does not affect the equilibrium price. That's what we mean by liquidity. Okay, now factors that influence exchange rate. Recall our discussion regarding if you have studied with me the microeconomics, we talk about the concept of movement and shift, right? I think all of you guys are already studied economics with me. So what do we mean by shift and what do we mean by movement? Shift means when you have to make a new curve. Shift means we are not here, we are not here, we are not here. We have to make an entire new curve, right? So we call this is shift. It means there is a movement in the quantity, and the reason is not price. It means the reason is not this price, not the exchange rate. It means there are other factors. So that's why we call this factor that is influence the exchange rate. It means our price is going to be changed due to some other factor. And what are those factors? They are change in inflation, change in interest rate, change in income, change in government controls, and change in expectations. So whenever these kind of incident occurs, our exchange rate would be changed. Again, one more time, I'm repeating again. The exchange rate will change over time as supply and demand schedule changes. Is because of exchange rate depends on the function of changes in the differential between US inflation, because this book is US centric. So always imagine yourself that you are in US. So